Hello, ladies and gentlemen. Welcome back. This is Christopher Aaron. This is the iGold Advisor channel. It is April 6th, 2022, and we need to talk about the gold mining sector, which will include the silver mining sector. Listen, I love the physical precious metals. When I'm thinking about a long-term savings account, I go for physical gold and physical silver. Anything, that I'm going to need in less than 6 months to a year, I generally want to keep in cash. Anything longer than that, though, feels good to me to keep in physical precious metals. That said, if physical gold rises by 50% from here, let's say it's pushing 2,000, let's say it starts pushing 3,000 within the next few years, which is very reasonable. Let's say that happens. That is not going to make me or most people rich. It is not going to alter our possibilities in life in any sort of radical way, a 50% move. I have experienced what it is like to radically alter your options in life during the last cycle from 2007 to 2011. I was buying a lot of the gold miners in the crash of 2008. I'll give you an example. Wheaton Precious Metals. I specifically remember the day when I bought it for $2.75. It ended up going up to $40 per share. Do the math, if you're investing any sort of reasonable amount. I had that happen to a number of companies. Now, I'm convinced that similar moves are setting up in this cycle, and we actually haven't seen the moves yet. That's the great thing. We've seen the moves in gold itself. Some of the senior large cap gold miners have already had decent moves, but the big move in the juniors and some of these smaller companies that will have life-altering returns is still ahead. And so for that reason, I have no problem sharing the research that I'm using here, speaking my book. This is how I'm investing. This is how my clients are investing. And this presentation is designed so that you can see the reasons why we are doing that. If you're not interested in changing your life, this is not the video for you. If you want to have the possibility of, let's say, 2 to 3 to 5 years from now, looking back and being like, wow, I can do things now that I never could have imagined doing 3 years ago, this presentation is for you. I just want you to understand the possibility. It's here in front of us now. It will not last forever. Please look at our thesis coming up here and decide on a course of action. So this is entitled A Gold Miner's Update, and a subtitle, or How I Learned to Stop Worrying and Love the Charts, because that is what gives us the confidence to actually take this path, is a strict, disciplined, regular study of the charts. Make sure to hit the red subscribe button and the bell icon to be notified when these free videos come out. And you will also know that I can't post a video every single week. I haven't posted a video here for 3 weeks. So make sure to follow our Twitter feed at iGlobalGold, because sometimes I have a chance to post on there in between these videos. I have a lot on my plate right now. I try to produce as much free content as I can, but it can't be every single week. So follow us here on Twitter for some more frequent updates. Let's get into it. Of course, no opportunity in life comes without risk, so you better believe there's risk. Please make note of our legal disclaimer. There's a risk in everything, including holding US dollars in the bank. What if the value keeps dropping by 10% every year for the next 10 years? You will lose most of your value. That's a risk as well. That said, let's look at the opportunity in front of us. First, let us rewind. Big picture view on the gold miners. This is the GDX Senior Gold Miners Fund. And if you say, I'm only interested in silver, remember, this fund has about a 20% weighting in the silver sector. So this is going to be close to the analysis for the silver miners itself. So please follow this analysis and know that silver will move on a slightly more delayed level than the gold miners. 2006 to present, this is it. This is all the data that we have for the GDX. This is when the GDX began back in 2006. So, nice orderly bull market, panic, crash of 2008, recovery. Gold peaked in 2011 at 1920 per ounce. Bear market from there back down almost to 1,000 to where we are today. So the first thing that I do when I'm approaching charts like this, and I know there's some of you that like to study charts as well. And so, part of what I like to do here is not just, I could just give you a takeaway. I could just say, hey, this is the bottom line. And if you want that, you can fast forward to the end. But what I think is better is to actually show you the process that we use here to analyze these charts. You can learn this process and you can apply this not just to the GDX Gold Miners Fund, but to individual gold miners, individual stocks. For that matter, you can apply this type of analysis to any other market. Every market has its own peculiarities, but the principles apply. So from 2011, let's take it into the present. 2011, the peak. What I like to do is start identifying the major trends that are visible. Major trends. In this case, we're talking about the trend from the absolute peak in 2011 in the gold miners, connecting the most important peaks along the way down to the very last peak before what? The trend, the downward trend, clearly breaks higher. Now, something was alerting me in 2015 that this break higher was going to occur. I couldn't tell you the exact date, but I was thinking it was going to be sometime in early 2016. Something was happening here that alerted us to this ahead of time. What was it? It was the fact that the lows here, we could see the highs coming down very steep, but the lows were coming down at a less steep slope. Can you see this? 1, 2, 3, 4 in a row, major lows, while all the major highs are coming down quite rapidly. That pattern is a bottoming pattern. Anytime you see lows coming down at a less steep slope than the highs and an apex forming on the chart, that is a nice and reliable bottoming pattern. Is it going to be 100% every time? No. Most of the time. You're trying to stack things in your favor most of the time. Keep doing that throughout your life. You're going to come out way ahead. So we have this pattern here, and there's a name to that pattern. By the way, this is when we started this channel, late 2015, August 2015, actually. In retrospect, that was pretty good timing, wouldn't you say? But it wasn't all luck. It wasn't all, gifts from the divine, although some of that had to do with it. It was following a chart pattern like this. I was keying into this wedge here on the chart, and this is what started to alert me that a change was coming. So I decided to start publishing videos. If you don't believe me, go back to the archives. I don't delete anything here. Go back to the archives, look at our first videos. Yeah, the format is not quite what it is today, and the presentation was a little slower as we were just getting off the ground. But we were talking about this bottom forming in 2015. Some of you have been here since that point. I thank you for being here still with us, and you'll know exactly what I'm talking about. You remember the first videos that we were producing here back in 2015. So we started here at the end of what? This pattern, the terminal wedge. I was getting very, very bullish. When you have a sector that has come down 80%, it's lost 80% of its value. It can't lose 100% of its value. You've lost 80%. That's telling you, hey, time to start looking at this. And then you start getting this bottoming pattern. That's like, wow, okay. You got a gimme, a real slam dunk opportunity here setting up. So sure enough, we get the breakout from the terminal wedge right there. You get the massive move in 2016. Then what happens? We start forming this. Can you see this peak, this peak, this peak, and this peak all matching up, giving us something of a base resistance. So that is in black here, black for your awareness, horizontal resistance in this case in black. And then notice what happens when we break the resistance. We shoot higher, and then what happened? We started coming back into the base resistance zone. As a side note, isn't this interesting? Note that the peak after breaking the base resistance, look at this peak right here, and notice that that matches almost exactly with the 61.8% Fibonacci retracement shown in light silver. Retracement of what? Retracement of the entire bear market. So these numbers, I mean, the fact that this market stopped on a dime and reversed at this number, you know that nothing is random in this world that we live in. Nothing is truly random. There are patterns in everything. There are patterns in nature. There are patterns in human nature. There are patterns in the seasons. There are patterns in our sleep cycles. There are patterns in our work cycles and our life cycles. And there are patterns in our behavior in the markets as well. So we stop right there at the 61.8% fib retracement, and then we start coming back down to retest the base resistance zone. Now, something got a little dicey, a little bit challenging right in here in late 2021. It looked like this was going to fail to hold above the base resistance here around this 31 level. Right there in October, November of 2021, it looked like we were going to fail and this whole thing was going to just abort and go lower. But then we saw this quick recovery of the base resistance. Quick recovery is telling me it's not really breaking down, and you start to get then the idea of that being a false breakdown. A false breakdown is exactly what it sounds like. It's where you get a brief violation of a key. We're talking 7-year resistance, broken support. You get one of these false moves to the downside. Not only that, but then we were starting to say, okay, so if that was a false move, so this is not going to be a catastrophe, this is not going to be the end of the world, we start looking at the shape that the pattern itself was taking and getting into this place. Do you recognize this? You should. It's the same as this right here. Boom. Once again, it's a wedge. Now, these wedges, as I said, are very reliable patterns. If you spent your entire career and only perfected learning these wedges, you would have a major advantage over people that just sort of read about stocks online or read some sort of fundamental news piece and decide to invest, because the wedges are not every single market will bottom with a wedge pattern, but anytime you see a wedge, it is telling you that a bottom is setting up. And then the context becomes key. So in this case, when you've already declined by 80%, we would call this a terminal wedge. It's the end of the decline. In this case, it's not a terminal wedge, but it's a wedge nonetheless. And this wedge is coming into place, what? At the retest of the base breakout. So still critically important. And then boom, look right there. We have broken the wedge here just over the last 6 weeks in the gold mining sector. So this is how the charts look to me. You see anything else noteworthy as far as, critical? We could talk about a lot of the shorter term patterns that were coming into play here 2017, 2018. I'm not really focused on that. I'm focusing on the big picture here. Where are we now? Bear market over, moving sideways for 7 years, broken out, retest, wedge now broken, moving upward again. Okay? Let's zoom it in now. Let's take it into the last 2 years. Let's bring that in. There is the wedge that I was just talking about. And let me show you why I think over the short run, we are coming due for a bit of a retrace, a bit of a correction here in the gold and silver miners, and then what the opportunity will be. So let's look at this. Why is there going to be a bit of a retrace? Clean up the chart for a second. Let's focus on the short term. we are coming into a fairly significant resistance zone right now as we are speaking. Let's look at the three different levels. Number one, we have black, this black dashed line representing this peak back from 2021. Notice how when we got up there again just about a month ago, this was clearly rejected. And here it looks like again we've gotten rejected once again. So this level right around 40 on the GDX is clear overhead resistance. That is the first level. The second thing that we're looking at is the most recent attempt at a rising trend from the September bottom. Notice this low, and in here, broken. We keep this in the turquoise color for broken trends. Notice that this trend in here was rejected right there from the lower side. So that is the importance of continuing to monitor broken trends. Just like we still have this bottoming wedge, the primary pattern, we still have this on here. I haven't deleted it from the chart because this, the blue, should now exert support on the way higher should the sector fall back down to this level. The same thing happened back here with this former short-term rising trend. You saw resistance come in on the broken side. So this is happening at almost the same level here, right around 41. We are still bumping against that former trend from back in September. So that's the second significant resistance level that comes in here at the 40-41 level. The third significant resistance level is the 38.2 Fibonacci level of this entire decline from the peak down here on the short-term chart, 38.2% level, or we could call it 61.8% retracement. Either way, they're mirror images of each other. That level comes right in here just below 40. So in sum, we have three important resistance levels all within about 1.5 points here on the short-term view. And that tells me we are going to be at a resistance confluence right now. There are multiple technical levels that are exerting influence on this chart all at once, and thus the highest expectation here is for the GDX, representative of the entire gold and silver mining sector, to back off here over the short run, next 2 to 6 weeks. Okay? The next visible support area is right down here around 35 to 36. That would represent roughly a 12% pullback if we came down to 35. This is these peaks back in there, you can see in black. But the thing is, I don't know that 35 is really going to hold yet. We're going to have to wait to see if this level holds here around 35. So this may be the time to consider, if you're heavily exposed in the gold and silver mining sector, this may be the time to consider some defensive action. You could sell some of your positions. You could open some inverse ETFs or some puts. Or if you're not already in the market, you could just wait, because I think we're going to come back a little bit here. Remember, this doesn't have to be an all or nothing decision. This doesn't mean sell 100% of everything you own and try to buy it back 10% less. But this looks like it's going to be a modest type of correction here if it bottoms at 35. Now, this is a moderate support level at 35. As you can see, it's a light dashed line here. It's less significant than the solid blue. So although I hope that we just come back to 35, 36 and then continue our way higher, which would be one possibility here, I think we have to open ourselves to the possibility that this may come back all the way to retest the bottoming wedge pattern, which would be more like in the 32 to 31 level if that were to happen again. And then we would round up more like in the third and certainly into the fourth quarter of this year. That would be the more challenging scenario here, but it would give people a bit more time to finish accumulating individual gold miners, individual silver miners, and in our elite private placements, we would get the chance to do, let's say, 1 or 2 more private placements at really favorable terms, because no one would be paying attention to the sector in here. So we take the sum of the short-term view, we add that into the long-term view, which remember, we had broken out, come back, retest. All we're seeing in here is the twists and turns now that have to happen after the market has come back to retest that critical 7-year long-term base. And all we're doing is we're basically talking about shorter term, intermediate term, next 3 to 6 months. Do we need to come back only 10% here and then power higher? Or does it need to be more like a 20% correction, let's say from 40 back down to 32, let's say like a 20% correction across the large caps before this thing can really have its high-powered move? That's the question. I told you I can't give you every single answer here. I can show you the data that we are studying in real time to make these assessments. And what we do is we evaluate this. I mean, I evaluate it most every single day. But as far as presenting it to you and subscribers, we present this at regular intervals, typically once per week or every several weeks when we're looking at these charts, okay? So as we're coming into here, we will evaluate how is this support looking. Is this looking good? Are we seeing some sort of a bottoming pattern? Can you imagine a mini wedge forming in here and then we power higher? Can you imagine some sort of a downtrend break and then we power higher? Or no, is this thing really rolling and accelerating down, in which case our next logical target is down in here before we round up a little bit later in the year. So, if you're with me this far, here's where things are about to get even more exciting. Remember, I'm not in this sector just because I hope to make 10% per year for the next 10 years like, mainstream stocks. They tell you, you could reasonably expect maybe 8% returns per year before taxes. That's not why I'm in this sector. You have to be excited. There has to be something exciting coming here for people to pay attention. Now, most people are going to chase the sector after the move is over. So I know if you're listening to this now, you're a contrarian, and you're paying attention here while we're still basically just rounding out of some of those lows. We're basically just clearing above that base, that 7-year base resistance in the gold mining sector. So you're paying attention now, which is great. And I just encourage you, think about this. Think about the data points we are about to talk about. If you're in the gold mining sector, you must be ready to attempt to change your outlook in life, because that is the potential here. And consider sharing this sort of analysis with other people. But, you can't share this with your mainstream friends. You can't share this with people who just say, I just contribute to my 401k and that I don't worry about anything else. They're not going to be able to listen to this. But think very closely, because we don't just want to be, sitting all alone on top of a mountain under a pile of cash one day. We want as many people joining us for this ride as possible. It's just more fun that way. Not everyone will. Most people, as I said, will not pay attention to this until the very, very end of the move. And we're nowhere near that yet. How do I know? Because look at this. When we talk about relative strength, gold miners versus gold itself, the companies that produce the thing versus the thing itself in ratio format, going back for 16 years, we can see that this thing here has still not broken out in favor of the gold miners. In other words, for the last 7-8 years here, although both the gold miners and gold itself are higher, they have moved in lockstep. They've moved 1-to-1. Yeah, there's been some oscillation here along the way. But as the net sum, the ratio of the gold miners versus gold is nowhere near where it was back in 2011, let alone back pre-financial crisis in 2008. And this is the best pattern we could possibly look for. If you've been with this service for a while, you know that this is a basing pattern. This is the same pattern that the GDX itself has already broken out. But even in that breakout, it has not broken out versus its own product. You've still seen movements in gold and movements in the gold miners roughly on par. This is getting ready to change, and we have established data here for what a proper valuation of the gold miners versus gold itself should look like in a bull market. From where we are right now, around 0.02, remember this is just an index, it's a ratio between two different parts of the precious metals sector. It doesn't really matter what the number is, we're just talking about a ratio. But from 0.02 up to 0.06 is a tripling of the average gold producer to get back to these established valuations. Now, these are not made-up valuations. These are not pie-in-the-sky valuations. These are not valuations that anyone would say are ludicrous or far out. These are established valuations that existed for actually about 5 or 6 years, back between 2002 and early 2008. This was the established relationship between the gold miners and gold itself. And what I'm saying is this thing looks like it's getting ready to break out, and the average gold miner would need to triple at today's gold prices just to get back to these valuations. So in other words, if you're telling me, hey, I have I want to try to really strike it rich here. I have the risk tolerance and I want to try to change my scope in life. And you say I have $10,000 or $100,000, whatever it is. And you ask me, should I put it into physical gold or the gold miners? I'm saying, look, there's risk. Of course, everything has risk to it. But the average gold miner at today's gold prices needs to triple to get back to where it was in the previous cycle. So you've got about a 3x upside with the gold miners that you do not have with gold itself just at today's gold prices, let alone if gold goes to 3,000 or 5,000 or 10,000, we will multiply that out, okay? I think gold miners are getting ready to break out. This is what the established data shows. Again, I'm not making this up. I can't just, fill in random data points here on this chart. This is publicly available data on the relationship between gold miners and gold itself. Then, if we were to look at an even more interesting ratio, let's look at the gold explorers versus those gold producers. Now, we already said the gold producers are undervalued versus their own product, gold. But then if we look at the companies that are exploring for gold versus those very same undervalued producers, and we do the same sort of base analysis here, you can see that the average gold explorer would need to double in price versus the average gold producer just to get back to these 2011 established peak levels. These are gold explorers versus the gold producers. We are currently at a ratio of around 0.8. The previous peaks were up here around 160. That's a doubling of the average gold explorer versus the average gold producer, once again at today's gold prices. We've yet to factor in any higher gold prices. So, doing the math, this is what it boils down to. I'm spelling out to you my investment thesis here, the investment thesis of our firm, the investment thesis of clients that we are working with. I want you to see this data and then make a decision how you are going to go forward. Do I want you to join us here? Of course I do. That would be great. However, you can also do this yourself. I want you to see the data, though, because you must be motivated in order to do this. You must be motivated to get through the volatility that is going to come ahead. This should provide you with the motivation. Let's do the math. Let's add it up. We already said this. The average gold producer needs to triple at today's gold prices to return to those previously established values, a 3x. Then we said that the average gold explorer needs to double versus the average gold producer to get back to previous peak valuations, a 2x. We just talked about these two things on the last two slides. Do the math. You take a 3x multiplied by a 2x, that gives you what? If you're going to be in the gold explorers, that gives you a 6x expectation here. If the average gold mining company needs to triple, yet the average explorer needs to double versus the average producer, that gives you a triple and then double the triple. This is how reversion to the mean works when you're talking multiple ratios that need to revert to the mean simultaneously. I expect most of the gold explorers, as it is, to roughly have a 500% or 6x return. Remember, a 2x is a 100% return. So a 6x is what I expect when you multiply out a 3 and a 2. So far, this should make sense to you. Now, this will be very nice. This will be very nice. However, what if we start to factor in higher gold prices? Remember, all of this was at today's gold prices. What if, let's take a reasonable, modest, higher gold price. 2,800 to 3,000 in that range. I think that's perfectly reasonable for the next 2 to 3 years. I'm not talking about 10,000 yet. I'm not talking about, the dollar going to zero and hyperinflation. I'm talking very reasonable. Gold has just risen by 50% over the last few years. Why can't it do that again? So if we are going to have a 50% increase above these levels, because that was at today's gold prices, 50% when we're doing it in X form is a 1.5x. We are going to go 1.5x on 6, yielding 9x. 9x is what I expect the average gold exploration company to achieve as gold is approaching 3,000 over the next few years. This is what I expect based on established, visible, published, real-world data going back for the last 15 years. You can see the data. 9x. You're starting to approach some life-changing scenarios here. Think about it. Think about if you invested $10,000 and you had a 9x over the next 2 to 3 years. Think about if you invested $100,000 and you had a 9x. You're starting to get into some extremely lucrative scenarios, not based on taking insane risk, not based on investing into anything that is, doesn't make sense or doesn't have an established valuation criteria to it. We have all the valuations here that we've already seen. Aha, what if there's one more piece? If you are going to do all of this by private placement with us, where we get not only the shares that we're talking about in these gold exploration companies, but we also receive free warrants with every single investment in these gold mining companies that we expect to go up 9x. The free warrants give us nearly a 2 times upside above and beyond the actual companies themselves. I say nearly. It's not exactly 2x upside. It's slightly less. It depends how high the companies go. The more the companies rise, the closer it gets to the 2x level. So let's use an estimate of 1.75. Okay? This is what happens when we get free warrants with every single share that we purchase when we purchase these companies. The very same companies you can buy in the open market, but we do it by private placement. We then multiply that 9x by 1.75, giving us nearly a 16x expectation over the next 2 to 3 years for the gold exploration companies that we are buying by private placement using real-world visible data. The sum takeaway is we expect to achieve approximately 16x or 1,500% returns over the next 2 to 3 years. This is what I expect. Can I guarantee this? Absolutely not. Do I expect it for myself? Yes. Do myself and numerous colleagues who are all studying this data with me from different sides of the spectrum, and we're looking at the absolutely historic undervaluation of gold producers versus gold itself that would need to just triple to get back to those previous valuations? Do we look at this and we say, you know what, this is insane. This is the opportunity of a lifetime. That is exactly what we are saying in those conversations. And then we look at the gold explorers that are undervalued versus the gold producers. And then we say, what if gold itself goes higher? And then we're doubling our upside of the entire sum of this by the free warrants. This is what I expect. This is why I'm doing this. I said to you earlier, I'm not here. I'm not involved in this sector to try to get 8% per year or 10% per year. It's just not motivating to me to do that. I am here to radically alter my position in life. I've already done that in previous cycles. I want to do that again. And I want you to come along with me and do that together. That is what I want to do. 16x over the next several years. Guys, what's going to happen is that when we get these reversions to the mean across both of those ratio charts that we discussed, what's going to happen is that everyone's going to start piling on board, and it's going to be great for the first year, 1 to 2 years as that reversion is happening. But then the mainstream is going to start coming in, and they're all going to start subscribing to this channel and subscribing to my service, which will be nice initially. But the problem is going to be that's the point several years from now when I'm going to start changing my message. And I'm going to start saying, hey, we are approaching a significant top. We've already made 10x or 16x as I expect. We're approaching a top, and now it's time to sell. That's going to be my message a little bit later in this decade. And then all those people that are rushing in then are not going to like me. But that's okay. Because if you're listening to this now, the opportunity is still ahead of us. The opportunity is still ahead of us, no matter how you want to do this. I just want to let you know ahead of time, several years from now, I will be changing this channel. When we get close to those mean reversions on this chart, on those charts, I will be changing this channel. I don't know if I'm going to stop the channel altogether or if I'm going to start focusing on other investments that I'm making or what. But we will not be having the same message here when those ratio charts break out. That move is still right in front of us, despite the short-term volatility. So, if you're listening to this, if you've really taken this to heart, the reasons why we are here is to try to change our lives in this sector, to change our lives forever. You only have to be right once in your life to change your life forever. Think about that. Decide how you want to do it. Are you doing all the research and following all the support and resistance levels and all the analysis of all the different markets on your own? Bless you. You may have another job, though. You may have other things that you do full time. And to be honest, maybe it's worth it for you to pay a little bit up front to have research and analysis to complement what you are doing on your own from someone who does this full time. I hope you think about this, and I hope you will join us. Precious Metals Intelligence is our open market service. We talked about the 9x potential when we multiply out the gold miners times the gold explorers times a 50% increase in the gold price over the next 2 to 3 years. These open market companies are the ones that I expect to rise roughly 9x using real world valuations. The service called Precious Metals Intelligence includes all those companies we are buying and selling, as well as videos like you're seeing. And we cover more in depth. We cover the US dollar, we cover the stock market, we cover silver every single week. If you like hearing from myself, but you say, sometimes Chris doesn't publish for several weeks in a row, Precious Metals Intelligence, 50 weeks per year as things stand right now. If you want to get in with us on those private placements, remember, which offer nearly that 2x additional upside above the open market purchases, Elite Private Placements is for you. You will get those free warrants that we talked about. You will also get a free subscription to Precious Metals Intelligence, so you don't miss anything that we publish in the videos or in any of the flash updates. You get all that, and you get access to those highest leverage companies with those warrants. No matter how you decide to do this, I am so excited about this. I mean, we see those ratio charts that are rounding up. Ratio charts do not stay low forever. Throughout history, they revert to the mean. It looks like we are in the right place at the right time. There could be a bit more of a pullback on the GDX here coming. Remember that. And so if that gives us a window, let's say for the next 2 to 6 months or so, depending on how far that retrace wants to go, if that gives us the window, I think that is the final window for either of these methods to accumulate your portfolio for life-altering potential. We are in the final window now. The final window should be the most challenging part of it. It should be when most people give up. That's how markets work. They have to throw off the last of the people at the very end before the life-altering returns occur for those people that are hanging on. I encourage you to decide which category you want to be in. If you would like to speak to me one-on-one, please know you can reach me for consultations. I'm fully independent. I take no money from any bullion dealerships. I take no money from any of the gold mining companies that we do research on here. Fully independent. I work for the benefit of subscribers and consultation clients, so know that you can reach me on the consultations tab. Once again, you have to be excited to stay in this sector. I hope that this presentation gives you something to be excited about. Share this with someone who you think needs to see an exciting piece of data about gold, because it can be really hard when we're seeing gold kind of grind lower and maybe the GDX drops 5% tomorrow and silver is back down to $23 in a couple weeks. It can be really tough. So share this with someone who you think needs to see the data. Whether or not they join my service, I don't care. They do it themselves. Fine. I want people to see the data. Take care of yourself. Thank you for being here. Thank you for those people who support this channel on Patreon. Stay healthy, and I will see you for a broadcast soon.